Here we're coming from what it looks to be a downtrending price action of lower highs and lower lows, kind of forming something like a descending channel, pretty much just a market that's constantly going down over time, more specifically on the 4-hour chart. But bullish pressure kicks in, and the market prints a series of bullish candles, which eventually break above the past swing lower high. A break of the past swing lower high during a downtrend is the first major signal of a trend reversal, so a market structure shift. If you're looking at the swing levels from the highs, it's moving like a downwards channel that reverses into an upwards channel. And similar, if we're looking on the swing lows, we're now forming what it looks to be the beginning of an upwards channel, which is simply just a beginning of an uptrend. But we only have one pattern of a higher high formed, being the higher high that created the market structure shift. So far, we don't have the higher low yet. So the high time frame uptrend is still not confirmed yet. It would confirm only if the market would validate a higher low. In order to validate a higher low, we need a break of the past high, so we need the market to bounce to the upside. The structural level where the market fills and moves away from it to the upside are demand levels, and the demands are the last bearish candle before the bullish action started happening. Shortly after the bearish momentum increases, pushing the market down right into the demand. Most traders are looking to buy this demand because they see a shift from a downtrend into an uptrend, and they see an unmitigated demand. And let's see what happens next. So we almost got stopped out, then quickly bounced to the upside. By now, traders would feel a relief, and they now expect the bullish momentum to continue. But instead, after just a small pullback to the upside, the market breaks down the demand, losing the trade. So it turned out that this market structure shift was actually a trap or a liquidity grab. And of course, you can't actually know the future to such an extent, so know that this would be a trap, because it actually respected many steps that would suggest this to be an actual valid trend reversal into an uptrend. But the reality is that it broke below the demand, stopping us out of the trade with a loss. But an important clue is that after a trap has been set, and the previous trend has continued into a downtrend, since we see that we've now got another break of the swing low, so a bearish break of structure. It's now even a more strong indication that the downtrend will keep holding for some more time, and one good opportunity might be enough to take out the past loss trade. So if we're looking for a setup, during downtrends, a pullback will often happen, and as I said many times on my channel, a pullback on a downtrend is a low time frame uptrend. This low time frame uptrend is there just to fill a supply or a resistance, so the market gathers more sell orders to take the market into lower lows, basically just to hold the current high time frame trend, which is a downtrend. So the setup planning has a clear logic, the stop loss being placed above the supply, since we're not expecting a higher high, but a higher low instead. And the exit target logically should be below the past low, since on downtrends we expect past lows to break into new lows. After logically placing the targets, you can manage the setup's risk-reward ratio. For example, in this case, if the risk-reward is too high and unsustainable, we can widen the stop loss, or even tighten the take profit. The pullback is happening right now. The market fills the demand, opening the order, and the exact next candle rejects down from the demand, pushing very aggressively to the downside. And it's actually just two candles that opened and closed the trade. By closing the trade, it broke into a lower low, so a break of structure. After a break of structure, we look for a pullback to the upside. And on the pullback, we look for a supply or resistance so we can find an opportunity to follow the market again into lower lows. So basically, that's just trading with the trend. And of course, at some point this will not respect anymore because the trend will eventually reverse into an uptrend. The key stands in the risk-reward ratio. As long as you keep a positive ratio, you can lose many trades because just a few proper wins will overtake many losses. Now on this market, we've initially had this small sideways action. From where a large bullish candle breaks above all of the previous highs, a candle this large leaves an imbalance. The imbalance being the gap from the candle previous to the large one, connected with the candle next to the large one. This imbalance respected well, it got filled right here, from where the market pushed higher, breaking the last high with a break of structure. When a bullish break of structure forms, it often validates a demand, being the last bearish candle before the upside action started to form once again, and this is the only demand we have at this time. Demand that's right at this point getting filled. Now this recent price action of forming the swing high, then a pullback to the downside, followed with an upwards push that fails to break the past high, and instead, it breaks the past low. Most would say that this is a market structure shift towards the bearish side, and now they're saying that the market should enter into a downtrend. But the problem is that they're ignoring this demand. This downtrend was there to fill the demand and not to actually reverse the entire market to the downside. The external or high time frame trend would enter into a downtrend only if the market breaks down below this demand as well. It's only then when we can say that now we had lower highs here and lower lows here with the broken demand. Now we would look for sell setups on supply levels. But until this demand is still not broken to the downside, we're still following an uptrend on this 1-hour chart. But what if the same thing happens as before? What if the market fills this demand, then pulls up to the upside, giving the impression that this is an actual valid bounce that would continue the high time frame uptrend? But then it does this, breaks the demand down once again, and we're then entering into a downtrend. Well, the key difference here is that we actually have an uptrend compared to the previous market where we initially had a downtrend. Here we have 2 bullish breaks of structure, so we have more confirmations, while on the previous market we only had 1 trend shift. Here we also have multiple higher highs and multiple higher lows. And the actual downtrend would begin only if the market would break this demand. And by breaking the demand, it also breaks down below the previous swing low, so it would create a bearish trend shift coupled with invalidating a demand. And we could also take into consideration that this would be a filled supply, so there are also enough data to confirm a downtrend, but this happens only if we get the break below the demand and below the past swing low, because until then, we are still in an uptrend. Now there is a trick to take advantage of this bounce, so even if we would enter into a reversal, we can still spot a few buy-long setups. We can do that by refining setups, so moving into a lower time frame right when the market filled the demand. This is on the 5-minute chart, the same market and the same price we've had on the 1-hour time frame. The only difference is that we now see the low time frame price action in more detail, and especially the formations of the internal levels. Basically, in order to fill this demand, we've had an internal downtrend with lower highs and lower lows, and if this demand validates, we're probably going to see first a small upwards push that breaks above the last internal high. But so far the last candles are still bearish, so the problem right now is that we don't know where the market has a higher probability of beginning to reverse back up, because it can drop to this level before moving up, or to this level, or here. We don't know, and there is no way to know for sure, but there are ways to increase the probability. One of those is to look on the left of the chart, right where the high time frame demand is situated. But this time, we're seeing this demand that was formed on the 1-hour chart, but seen on the 5-minute chart. Now here we've had an internal downtrend with lower highs and lower lows. I wouldn't consider this wick as a higher high since it did not close with a candle above the past high. This was more of a trap rather than an actual trend shift. Because the trend shift happened a couple of minutes later, when this time we actually broke the past high with a candle closure, and since then, the market rallied higher. So having validated a market structure shift, we look for a demand inside this 1-hour chart demand, and it should be the last downside candle before the upwards impulse, right here at the bottom. And now we can come back into the recent price action. Now we refine the demand, and it's a much smaller area. So there's less room for the market to bounce. Basically, we increase the precision. So now we can look for a buy-long setup from this smaller size demand, with the stop loss below. And the first important exit would be above the last internal high, making this trade as a quick scalp position. So far, we have another pullback that's getting faded down into filling this demand, and we have the beginning of the bounce, now breaking above the last high, approaching the take profit target, which it hits shortly after. So, we broke 2 highs, leading to the take profit being hit, and the market went even higher, breaking more of the past highs. And if we zoom out the price action so we can see more price data, we can see more clear why this trick or approach is pretty strong, because we have a few scenarios. One is that the market holds a high time frame uptrend, so it looks to break the swing high. If that happens, we wait for a pullback and look for a demand zone on the higher time frames so we can identify another buy-long setup, and we just repeat the same steps of refining the demand by moving into a lower time frame. And on the scenarios where if this bearish market structure shift actually validates, so that would mean the market turning high time frame bearish, to confirm this, we just wait for the market to push higher just like it is right now, into filling a potential supply from a higher time frame, and we zoom back right into a lower time frame so we can spot a refined supply into hopefully looking to take the market down into bearish continuation. But the happy scenario is that in both of these cases, we already used this pullback to win a trade. So it won't matter if the market turns bearish or bullish, we just wait for the price action and only take action on opportunities. Now my members usually catch these opportunities where most traders just don't see them. By using our concepts and the materials in my program, they even build their own systems. Because it's really not that complicated. You can also check it out on the link in the description, and until then, have a great trading session.